Welcome to all of you. Thank you for joining us at this webinar on climate risk that we from Synechron are organizing together, as you can see, with Green RWA and ABN AMRO. My name is Sander Bolij. I work with Synechron, and I will be your host for the next hour. One remark I think I need to make up front, and that is there is at the top of your screen a possibility to drop your questions, your remarks, or your advices. There is a live event Q&A, I think, at the top of your screen. Please use it if you like. It makes the whole webinar more interactive, so don't be shy, ask whatever you want, and we will use your questions and remarks during the Q&As that will come later in the program. Let's see. Yes, the program. This is what we are going to do the next hour. We have two interesting presenters, being Tjeerd Krumpelman from ABN AMRO and Olivier Vinciguerra from Green RWA. They will introduce themselves later on at the beginning of their own presentations, but they will talk with you about climate change risks and challenges, and also in relation to credit risk models. And they will also dive into, and that's very pleasant, solutions for these challenges. After their presentations, which will last around 20 minutes each, there will be a moment for Q&A, and then we will use your questions from the live event Q&A button as well. As an introduction, I think it's meant to warm up you a little bit. I think it's wise to say something about Synechron, because I guess that not everyone in this room knows us, being the organizer of this webinar. We are a business consulting firm working only for financial service companies around the globe with around 11,000 employees. We do that. We exist since 2001, and as you can see, we have a very strong focus on digital issues and technology issues. We have 22 offices around the globe, and in Amsterdam we have one of these offices where around 100 people work. And as you can see at the yellow marker, we also focus on sustainable finance in Amsterdam. And that is the topic of today as well. So as an introduction, what is sustainable finance? What I quite often hear is that people think that sustainable finance is new in the financial sector. I don't think it is. It is already there for many years, and maybe you recognize one or more of the voluntary frameworks on the left-hand side of this slide that we are working on in the financial sector now for decades already. More recent, since 2015 or 2018, we see all kinds of new laws popping up, especially European laws focusing on climate change that needs to be implemented in the financial sector. And that is more new, indeed. And it is impacting the financial sector because the financial sector has to change because of all of these laws. Every bank or every investment firm needs to change its strategy, its governance, its policies, the methodologies and systems and reportings. And it's an enormous amount of work, of course. And it also needs to change, every bank or investment company, its risk management procedures. And if we talk about risk managers and climate change, that is an interesting combination, because what I felt over the last couple of years is that many risk managers find it very difficult to translate climate change risks into potential financial impacts. It's very difficult to make that translation. And that is that's not weird that it is difficult, because climate change is a very difficult topic. What helped me enormously was the 2017 report of TCFD that you see here on the left-hand side. I think it was one of the first times that climate change and the risks were split into physical risks and transition risks, and also linked to financial impacts. So they gave an overview of how a physical risk, a flooding or a hurricane, can impact your bottom line, your income statement or your balance sheet, but also the transition risks. So changes in society, changes in regulations, how they can impact your bottom line. Keep this in mind. Olivier will also come back to this overview in his presentation. And if you haven't read the report on the left-hand side, I can recommend it to you. The same goes for the recent EBA report, which is the European Banking Authority. They published a report in June 2021, this year. It's quite recent. It is a report that is, I think, around 160 pages, but I think this is the most interesting part for this afternoon here. Because what EBA has shown us is what are the main challenges if you want to incorporate climate risks into risk management? Then you run into all kinds of difficulties, and you see a couple of these difficulties here. The first problem is that you do not have sufficient data, and if you have data, you lack the methodology to use these data in. There is time horizon mismatch issues, there is non-linearity, etc. I won't dive too deep into these challenges, but I only want to touch them briefly here. And what I hope is that our two speakers that will come up now will dive into these challenges with you together. We have two speakers who can show you how to deal with these challenges and also have some solutions for these challenges. The first one is Geert Krumpelman from ABN AMRO, and after Geert, Olivier Vinciguerra from Green RWA will get the floor. Geert, I give over to you. You have around 20 minutes. I will give you a signal if there is 5 minutes left. And after your presentations, we have 5 minutes of Q&A. The floor is yours.
Thank you, Sander. Just a sound check again. Can you hear me?
Yes.
Ah, great. Thanks, and thanks for inviting us to share some viewpoints on these relevant topics. I've named my presentation Climate, Data, Risks and Commitments. I don't think I'll cover all of them, but I'll try to emphasize on the connection and on the connectivity between these topics, and also referring to the EBA recommendations that Sander just shared relating to data and methodologies. So let me start off a little bit by sharing some background on ABN AMRO. On the next slide, we have embedded sustainability. Next slide, please, Sander. Yes, no, one back. Yeah, here we go. I see 2 slides now, but I'll keep talking and I think it will fix itself. We've embedded sustainability into the core of the bank in our purpose and strategy. And our purpose says we want to bank for better for generations to come. And in our strategy, we have the support of our clients transitioning to sustainability. Now, our impact as a bank is of course related to our clients' impact. And this is the beginning also of the data challenge. So how can we measure the sustainability of our clients, and how can we support them in their transition, and what risks occur in that space, and how can we become more aware of those risks and mitigate them or address them accordingly. Now, within the sustainability space, it's such a broad topic that we've said we need to focus on where we as a bank with our clients can have most impact. And that are the focus areas that are on the next slide, related to climate change, the circular economy, and social impact. And all 3 topics are relevant and have their own agenda, their own KPIs, their own programs, their own action items below them. And I think the one that is getting most attention at the moment, and probably also in this webinar, relates to climate change and the energy transition, and topics like biodiversity and addresses that focus area as well. But circular economy and social impact are extremely relevant for ABN AMRO, being a bank with around 5 million clients and some long value chains. We have an interest in those areas as well. But for today, probably the focus is on climate, so I'll address that. And on the next slide, I've included a brief overview. It's a limited overview of all these commitments that are either being signed or developed or imposed upon the financial sector. It starts with the Paris Agreement, where as a planet, you could say, we've agreed to limit global warming to well below 2 degrees. That has been translated into a Dutch financial sector climate agreement, where we re-emphasize that. And on a bank level, there are carbon pledges. There is the taxonomy that is coming up. There are the principles for responsible banking. And on a methodology level, there is a development called PCAF, which I'll get into later. But there's also science-based targets, 2-degree investing initiative, Poseidon principles, and as Sander mentioned in his introduction, the TCFD framework, that are all supportive of this transition to a low carbon economy, to support the combat of climate change and to reduce emissions. So they all have similar goals, but a different approach and a different meaning. And I'll share an overview of all these different methodologies in just a few slides, because I get a lot of questions on that topic. Are there not too many methodologies or too many commitments focusing on the financial sector? On the next slide, I introduce a next slide, please, Sandra. Yeah. So I introduce a 3-step program that I like to use or discuss within ABN AMRO as well. If we want to do anything around climate or carbon, first you need to measure it. Can you measure it in your portfolio in a high level way? So can you do a sort of a first assessment of carbon impacts and carbon exposure in your activities as a bank? And then the second is to report on those findings, and to do that either internally or externally or both. Ideally, you do both. And that should enable you to take some next steps in steering on carbon reduction. And if you want to steer on net zero, then that is your goal. If you want to steer on 2 degree or 1.5 degree scenarios, then that is your goal. That's all fine. But you need these 3 steps. You need to be able to measure it. And in order to measure it, you need the right data and the right methodology. PCAF is one of those methodologies. You need good disclosures. You need good reporting schemes so that you can monitor your progress. And ultimately, you need to be able to steer on this as management of a bank or board of a bank. And just to get in, before I go into the details of the PCAF methodology, just to share an overview of all these different methodologies, I introduced on the next slide. I think we have, well, I'll start with PCAF and then I'll get back to all these different methodologies. For ABN AMRO, the biggest part of our balance sheet is in real estate. It's almost 2/3 of all our activity. It's around 150 billion in mortgages and another 30 to 35 billion in commercial real estate. So it's a big part of our balance sheet. And if we want to truly measure carbon, then it should be applicable to our real estate at least. So how do we do that within the PCAF methodology? And it's relatively easy and a high-level analysis of the carbon for this part of our portfolio. And I'll demonstrate it on the next slide. First, you start with the next slide, please. Yeah. First, you start with the energy label, and you need to know what the energy labels are in your mortgage portfolio. And this is public data, so you can find it, right? You can match it to your mortgage portfolio in a relatively easy fashion. And then you use the average energy use per label, which is well documented, and it's a standard in the Netherlands. You don't have to calculate this yourselves. And you multiply this average energy per label by the emission factor for gas and electricity. And we do that on a Dutch level because most of our mortgages are in the Netherlands. That brings you item C, so the carbon emissions per energy label. And then there's only one more thing to do. You multiply the carbon emissions per energy label times the number of objects that you have as a bank within that energy label. And that brings you the total carbon emissions for your mortgage portfolio. Now, we've debated a lot within the PCAF community, which is now a global community of 170 financial institutions. And we have had a lot of discussions. Should we make a correction for instance, loan to value of the property? And some banks do this and some banks don't. At ABN AMRO, for now, we've said, let's just stick to this for now, but maybe in the future we'll make a correction in terms of loan to value, similar to what we do in corporate loans that I'll mention a little bit later. But this is like the getting started guide of carbon accounting for a bank with a large mortgage portfolio. And on the next slide, you'll see what that looks like in terms of numbers. Next slide, please. Sander?
Yeah, this is the next slide.
No, I'm still
Okay.
looking at PCAF methodology residential mortgages.
I see the next slide now, emissions real estate.
Okay. Maybe I have a lag in my. So if you're looking at the emissions in the, this is the one. So this is what it looks like in our disclosure. So I mentioned that you need to measure and then report. So this is a snapshot of our annual reporting, where you see the number of objects per label, the total carbon emissions, and then on the bottom right you see 3.5 megatons based on 750,000 objects. That is the emissions of our retail bank mortgage portfolio. So relatively easy. Then going forward to the rest of the portfolio, and how do you measure that? On the next slide. And I do seem to have a lag, so I'll be watching on my other device the portfolio as well. So what do we do in the lending portfolio? That is the next slide. And then one more, which says the lending portfolio per sector. Sander, could you let me know what slide you have on the screen?
Yes, I have now the lending portfolio per sector.
Great. With the picture or the methodology?
The picture.
Okay, one more. We use the following data points. This is the one, third-party database of scope 1 and 2 emissions for our corporate and institutional banking clients. And we use the CBS database for our smaller commercial banking clients. And this PCAF data quality score, it's too detailed to go into it now. But if you go to the website Carbon Accounting Financials, you'll find all the details on data quality and on these methodology that I'm mentioning. So this is just a practical example from an ABN AMRO perspective. Where do we get the data and how do we report on that data on a bank level? And on the next slide, you'll see what that looks like in an overview of all the sectors that we finance for our lending. Again, just for our lending portfolio. And you see that per sector, we use Dutch averages, time multiplied by the exposure that we have, and that leads to carbon accounting. So this is not based on real client data. This is based on portfolio data. So it's less granular than you would like. So if you would like to start steering on this type of data, you need more detailed information on a client level. This is just to give you a sense of where we are on a portfolio level. And on the next slide, you see that we started steering on this. So this is the total overview. And on the next slide, you see where we are with steering. So yeah, this is the total overview. And then there's a slide looking ahead where we say steering. So we use PCAF to measure. We also use it as an input for science-based targets, where we've said we want to develop our targets in such a way that we will become well below 2 degrees. And we're looking into seeing if we can up that target or that ambition. But the science-based target will bring us in line with what we agreed on in the Paris Accord and what we've signed up for in many other commitments, like the Dutch Climate Accord. I'm sorry this is confusing, perhaps it's a little bit of an IT issue, but I want to go back, Sander, if you can, to the many methodology slide.
No problem. It's on the screen now, at least on my screen, Chair.
It should have a heading, many methodologies.
Yes.
Okay, great. Because this is where I get most questions from other banks as well. How does PCAF relate to other methodologies? Shouldn't there be a convergence of methodologies? And please give us some guidance on all these different types of. Now the lights go off in this room. Shouldn't we have more convergence here? How can we fix this? And this overview, we attempt to give meaning to the different methodologies, because we do feel that there is a meaning to all these different methodologies, and there is a purpose to, and there's good reasons for using multiple methodologies in your own frameworks. And it's probably, maybe it's too small on your screen, and I'll definitely not go through all of them, but you see there's different categories. One is for target setting, one is for scenario analysis, one is for your strategy setting, and one is for actually taking action and steering, in our case, our bank into the right direction. And ultimately, on the far right side, you see that there are different methodologies for disclosing as well. And what we try to bring across here is that it's not so much a competition between these different frameworks or different methodologies, but they all have a different purpose. And if you know the reasoning behind the methodology and know what it's best used for, then you can actually make the most use of them. So you cannot use science-based target just as an example for simply measuring your portfolio. You need other data points before you can set science-based targets. You can align your portfolio and you can base your strategy and your scenarios on science-based targets, but you need other data inputs to know where you are with your portfolio. And this is part of a different publication that we did earlier, just to share that, the feedback that we are getting on all these methodologies. I think there will be more methodologies going forward for specific sectors as well. For certain parts of our portfolio, we will still need to develop new data points, new ways of measuring and steering into the right direction. So this was definitely a slide that I wanted to share with the audience today, and then bringing it to the challenges slide on which was my last sheet before I sign off or hand over to Olivier. The challenges that we see are on data availability, so having the right data points for our clients that enable us to steer the portfolio. That also relates to data quality. For instance, on the mortgage portfolio, we would really like to move to real data from either energy agencies or from the CBS, from the Central Bureau of Statistics. We are quite close to getting it, but it's been a challenge for a couple of years now that we are working on together with the other banks. But that would really improve both data availability and data quality. And I think the third challenge that I keep sharing wherever I have the chance is in the tempo, because I feel that the regulator is moving a lot faster than we are as a financial sector. And that is needed because we need to up our game as a financial sector, as demonstrated in the latest IPCC report, at COP26, in different publications. We know that we need to move faster than we are now, and we are still struggling with some of the same data quality issues or data availability issues as a few years back. So the pace of change in terms of disclosures, in terms of managing these numbers, needs to increase. And I feel that if we fail to do that, then the regulator will bring us even more strict criteria and more new regulations that we need to meet. So it's imperative that we up the tempo ourselves in terms of data availability, data quality, and steering our portfolio into the right direction. Now, sorry for some of the IT challenges that I had on my side, but happily hand over to Olivier to pick up from his perspective and come back for the Q&A at the end of the session.
Thank you very much. I hear myself now. Thank you very much for sharing your views and your challenges with us. Let's first do a quick round of Q&A, Chit, if you don't mind, before we hand over to Olivier. I can't see the questions coming in on my screen, being the presenter of the slides.
There are 3 questions for you, Chit, so it's probably good to address them now. First one is, hi, the time horizon mismatch, what does it mean exactly? And is there a need for real-time updates, info, outputs?
I think I have to answer that one because I mentioned it in my slides.
That was still for the introduction.
Introduction. What is meant there is that the average time horizon of a risk manager nowadays is around, 7 years, maybe 10 years, but never 30 or 50 years. And as soon as you want to calculate or assess the impact, the climate risk impact, then you need to calculate risks that can happen in 30 or 50 years' time. And that is the time horizon mismatch, that you don't have data, but you don't have the methodology either to do that. Maybe Olivier can, in his presentation, also reflect a little bit on that.
Okay, thank you. And then there's a question for Tjeerd. Why does steering come after reporting? It's an iterative loop for sure.
It definitely is an iterative loop, so I agree with that, but you need the data to be able to steer on. So if you don't know what you're steering on, then you don't know if you're moving into the right direction. There are always some things you can do, so absolute reduction is always a good starting point. But to really know if you're in line with your own commitments or with planetary boundaries or with certain scenarios, you need the data and the disclosures. There are a few financial institutions that say that they want to use this reporting mainly for internal purposes. I'm a bigger fan of disclosing it externally and getting feedback on your disclosures as well. But also, I mean, I'm also aware that some banks use it mainly for internal purposes, which is fine as long as you use the right data for steering.
Okay, thanks. And there's another one. A significant portion of the assets are out of scope for PCAF. Can you explain what's in there and how you might be able to close the gap?
Yeah, that's a great question. So within PCAF, we've developed now 6 standards for 6 asset classes, which are global standards now, but there are still parts of the balance sheet that are not covered by the methodology. So that are out of scope for that reason. That is, for instance, loans between banks and loans that we hold for our own, let's say, on our own account, our own activities. But also derivatives are quite challenging, and there are some certain parts of the balance sheet that we still have not discovered a methodology for. The biggest chunks that we have as a bank are covered. So investments in our private bank, mortgages, corporate loans, SME loans, those are listed equity. Those are all covered in methodology, but we still have work to do in certain other parts of our balance sheet and also for the balance sheets of other banks. And we're constantly developing. So there's a consultation now open for PCAF for the development of new asset classes, and we'll probably publish them early next year. The final, the new standard, but that was my point actually when I said we will still need to discover or develop other methodologies for different parts of our balance sheet.
Okay, thanks. There's one more. Will you use the PCAF methodology for the taxonomy reporting?
Yes and no. So taxonomy has some clear descriptions on which activities can be considered sustainable, and that aligns with the different asset classes of PCAF as well. So within the asset class, for instance, on corporate loans, you can. So first you need to discover what are your corporate loans, what is your carbon footprint there, and then you can align it with the taxonomy. So it's 2 frameworks. Both in that overview that I showed of the different frameworks with a different purpose. So the taxonomy is meant to show alignment with sustainable assets or green assets or whatever. So what is to be considered sustainable? PCAF is a carbon accounting methodology for your entire activity. So yes, it aligns, but it has a different purpose.
Okay,
Thank you, Tjeerd. Thank you very much.
Yes, so there are 4 more questions. Do we have some time, Sander, or is it something that we should address at the end, maybe?
I think that we should decide to move on, and that we will address the questions, the open questions, after this webinar online with via email or whatever with all the participants. That we will answer the questions that are not answered yet.
Okay.
Can we do that?
Yeah.
Given the time pressure here, because we have to thank you very much, Tjeerd, for your presentation and your answering these questions. And thank you, the audience, for bringing up these questions. That makes it more interactive and more fun. Thanks. Keep on going, I would say. Let's switch then to Olivier Vinciguerra of Green RWA. Can you please introduce us, Olivier,
Absolutely,
who Green RWA is?
Can you hear me?
Yes.
Correctly, it sounds all right. Okay, that's perfect. Let's get started. In case, thank you, Jet, for organizing this event with Synechron, and good morning to everybody from London, where I'm based. I'm going to talk to you a little bit today about climate-related financial risk and how we are looking to integrate that in the methodologies of banks. So maybe I'll start with a few words. If you move on the first slide here, yes, and thank you. Just to introduce very quickly what Green RWA is. It's a new non-profit that we created with a couple of colleagues or ex-colleagues. Which mission is really to create awareness about the bank's necessary role in the green economy, and to promote methodologies to quantify climate risk. And that's obviously the focus of my speech today, and ultimately to track and measure bank action contribution towards a net zero emission economy. So essentially, Green RWA role is really to put together communities of people and create some thought leadership around these topics, which are essential because our view specifically in Europe is that in an intermediated economy, which means that corporates finance their economy through borrowing to banks, directly to banks. You need the banks to chip in to effectively finance the energy transition. And just so that you have a number in mind, there is about 13 trillion euros of debt in Europe, and out of these, 9 or 10 are in banks, the rest of it being bonds, obviously. So that's why we created that non-profit back a year and a half ago. So just if you move on, Sander, one slide. This is where we're in a nutshell after a year plus activity. We have now 72 members spread around the globe, of course, because this is a global issue. So we are making sure every day that we speak at a global level. We have 8 corporate members. Of course, Synechron is one of our very big members, and we're very happy to have your support in what we're developing here. Thank you, Sander, and Raju, of course, who very early on understood what we're trying to get to. And we're engaging very regularly with financial actors, and that can be, of course, financial institutions as banks or insurers, but also with consultancies and fintech involved in that matter, and through also our community of LinkedIn followers, which represent today about 1,800 people, all in this industry. So it's a very focused, very interested community about what we do. And we're holding events regularly about climate risk, about energy transition, to our community and more publicly, and that's what we'll start to do early 2022. So of course we have a chapter form in London where I'm based, but also in Paris where I come from, as you know, and there is a big focus in Europe from the regulator, and it's going very fast, as Geert said earlier, and they are going even faster than what we thought, and here in the association, so it's a good thing from my perspective. But we also have a chapter from New York where we know that the regulator is onboarding now, specifically under the Biden administration. Everybody knows that US joined back the Paris Agreement as soon as Biden was elected, but they also joined the NGFS very quickly after that, and they are now playing catch up with Europe on these matters from a regulator point of view, and then of course from a commercial bank's point of view at some point. So this is where we are in an association. And just to tell you also, if you move one slide down, Sander, how we're organized and what we're trying to get to, because sometimes it's a bit complicated. So we're trying to summarize the way collaborate because it's essentially a collaborative platform on this topic. So if you look at the green box on the left and you start on the right of this green box, the modelization, that's the end game for Green RWA. Really put together the best methodology to represent climate-related financial risk at the financial institution point of view, whether it's the trading book or the banking book, with a big focus today on the banking book, and we'll talk about loans in a few minutes. And we're trying around this ultimate goal, we're building a community of geoscientists, macroeconomists, engineering economists to help us put together the right way to embed that data needed in the models we're building, whether it's from a climate scenario point of view, risk factors, meaning physical risk and transition risk, as well as green tech, so how technology is going to transform the economy so that we decarbonize it and ultimately mitigate the climate risk. And so this is a community which goal has to create these models, offer the IP, the intellectual property to the community and to the members of the nonprofit, as well as offering some open source code on the model so that the members, which can be, as I said, banks, but also fintechs or consultancies who are involved in these matters, can consume and then help banks implement effectively at the point where we reach a consensus, or at the point the regulator is pushing similar methodology that we would also, of course, propose to the community. So that's the way we are organized, and that's why we have a community growing faster and faster. So moving on a little bit now on why do we think we need a new climate credit risk to effectively measure it at the loan book specifically. The reason it's quite simple, in fact, is that the current credit risk models that financial institutions are using to evaluate their capital requirements are based on economic risk only. And the economic risk, the way it's measured, it's based on historical data. So if you look at the past crisis, you evaluate what is the tail risk of this past crisis, and this is based on that you're going to evaluate what is the unexpected loss of your loan book and hence the capital requirements against it. And the problem with that is that the climate risk, as we know it, whether you look at the transition risk or physical risk, which are, by the way, interlinked, you can't rely on the past data. They are, as we say, unstationary risk, meaning change in time, and we don't have the historical points to evaluate them properly. So we need to look forward. So once you understand that you're going to need to add new factor to your climate risk model to properly onboard and evaluate these risks into your loan book. Hence, we have developed first as quants, and then with the help of École Polytechnique and some other universities or other quants, a new model which is based on the current model that the regulator has imposed through the Basel framework, which is a one-factor Merton type Vasicek model. We extended that to a multi-factor Merton type Vasicek models, which can embed both transition risk and physical risk, but can embed also not too complicated, but it's a multi-factor model. It means that if you consider at some point that you have not only transition risk, physical risk, but you want to consider separately the legal risk, for example, which is a very hot topic right now, then you need to add another factor. And our model gives you that possibility. So what does it do ultimately for banks specifically? And you can see that in the next slide. The idea here, so just to give you a very quick idea of the impact of taking properly account of the climate risk in a loan book, if it's not well distributed against green loans, of course, is that you've got the typical distribution of loss of a loan book, which is represented in blue here, before you add any climate risk to it. And you can see it's typical. You have a given expected loss, which is the average loss that banks are using to measure and to do the credit risk of a loan. the typical distribution of the unexpected loss. But then if you add climate risk on it, and then this is an illustration here, you will see that not only your expected loss is gonna shift to the right, so getting bigger in a way, but also your unexpected loss is going to grow. And it means that at some point, when the regulator comes in and imposes that you take into account unexpected loss on the long term, then you might have to add some capital charge, or you need to be prepared on your loan book to understand where the risks are and how you're going to mitigate them in time, so that your unexpected loss doesn't have to grow and your capital charge is not impacted. And that's where we put the 4 goals of our model. First, it helps you addressing climate stress testing exercise with a very versatile framework. Compute a climate extended metrics for your climate reporting, giving you the view of both the expected loss and the unexpected loss, and you can report that under the TCFD agreement. But also at some point you can use it, with the green asset ratio that banks have to start reporting on next year. You will be able to use this to evaluate better or to calibrate your model through a GAR analysis. And then the third and fourth goals are about assess the sustainability of business model. So it means at the highest level, bank strategy, which decides to move on some sectors or to help some of their borrowers to transition to decarbonized local economy, meaning the economy of the corporate itself. Then this model properly input could help banks assess their strategy. Is that strategy working so that my expected loss and expected loss don't grow in time, and then pilot it properly over time. And this is something we were looking forward to work on with banks. And of course, that's the 4, and that's the provide steering tools to manage the climate risk and capture opportunities. Because in Green RWA, one thing I didn't precise at the beginning, but is very important, is that we have a very positive view of the energy transition. We think that the technology is here to help us go through that complex challenge of getting to a decarbonized economy, and that banks can find opportunities with a very fine-tuned piloting of their loan book, find the right opportunities with the right corporates to transform the economy, and also at some point to make sure they are not stuck with some what we call zombie loans, which are corporates who have no strategy to transition and represent a higher risk for the bank at the end of the day when the transition risk is going to kick in. So that's the goal term. Then one thing which is very important also, and I'm stressing that in the next slide, Sander, is that, of course, this model is a versatile framework. It's very flexible, it's very open, and we see that as a tool that banks will be able to use to dialogue with the regulators, both for the Pillar 2 and the Pillar 1 of the Basel framework, where the Pillar 1 being, of course, the regulatory requirements and capital, to properly assess and explain, what is the capital charge they should take into account or not, based on the way they assess their portfolio through a model like that. So very quickly, because I don't want to get too technical, but we take the loan book of a bank, we split it in a homogeneous group, by geographical region, by collateral type, by climate risk strategy, by whether it's the mitigation or the adaptation, and by economic sector, so that they have consistent correlation across among one group to the different risk factors that are to be taken into account in the model. And then we split all these models, all these loans in specific groups. So we have a bottom-up approach, which is quite data consuming, but that's ultimately what the banks will want to do and will have to do to fully assess their loan book. So that's an important point. And if you move to the next slide now, Sander, What's very important also in this kind of model, and this is where we think it's going to be very helpful to banks to manage the data challenge that climate risk is posing to all of them, is the way we calibrate a model like that. Because if you don't go the right way in calibrating such a versatile model, you're gonna fall into a huge pit of issues and data quality and data quantity that we are trying to limit here in our approach. So I just want to explain here a few principles of the models that we put together and its calibration, so that it's clear that you can simply represent the climate-related financial risk of a loan book. So the first principle here, very simple, I explained that at the beginning. Climate risk are additive to historical economic risk. So it's a different nature. One is looking backward, the economic risk. The climate risk is looking forward and is non-stationary. So it's additive to it. First thing, okay. Second thing, of course, physical risk adapt with time as CO2 accumulates in the atmosphere. So this is not us saying it. It's a well-known fact from the geophysicists. It's documented everywhere. Nobody challenges that. It's accumulating, hence creating this long-term risk on climate change. And this is very important because this is the way it's going to correlate physical risk and transition risk in the model. Third, the transition risk, the transition efforts or risk is the same from the perspective of a mathematical model, and the economic crisis reduce physical risk. So transition risk efforts, transition efforts is very obvious. The less CO2 we put in the atmosphere through transition efforts, through regulation or self behavior of corporates at some point, then the physical risk will diminish. That's easy. Economic crisis also reduce physical risk, and that's very important to have in mind and to represent the model. And the best example of that, of course, is the COVID-linked economic crisis, where we have a decrease of the CO2 emissions in the atmosphere of about 5% in 2020. So economic crisis, less CO2, that's simple. Then the last point, which is important in the calibration of the model, is the transition effort essentially stem from the political pressure generated by physical risk. So the more climate events we see day to day, and we see more climate events every day, effectively today. So I'm thinking, about the heat wave in Canada where they had 56 degrees, about all the wildfires, whether it's in Australia a year and a half ago or in California, or the 20 degrees temperature you could see in Siberian area in the middle of the winter. Then these climate events, make the population aware of the risk of the climate change, and hence put pressure on the regulator, on the government, and the regulator about transition. We need to transition faster. So that has a positive impact on the transition factor. So these interlinked relations between physical, economic, and transition risk are simply represented here, but they're obviously mathematically represented as the formula shows in our model. And if you move to the next slide to show how simple in a way this can be to calibrate such a model, we put a very high-level example here of how you could do it at the loan book level. There is only a few factors based on this link between the different factors. Makes it very simple, and you have only a few parameters to calibrate to be able to effectively run the model on your loan book. So first, you assume, and this is economic factor, that the GDP, you start from the GDP worldwide is about 90 trillion. You derive from that and from the past, what is the cost of the GDP crisis, and that's the standard deviation we're looking at here, 1.8 trillion. What is the house scenario from the NGFS or the IPCC showing from a GDP perspective cost also, and that's about a 20-year, looking from now 20-year forward, it's the equivalent of a historical GDP crisis that it would get to. Okay, and then you use all these factors to evaluate the four other parameters. I'm not going to detail all that. The next two parameters, meaning the hothouse scenario, the transition cost, here is the one where, what does it cost to properly transition to a net zero economy in 2050. And this is quite easy because we know that from different reports and specifically from the IAE, that there is a 6.3 trillion cost infrastructure investment every year around the world, and that 600 billion are coming specifically for the energy transition. So that relates to about 20 trillion over 30 years, and that's how we calibrate the transition cost. Then we have the political velocity, which is equivalent to the net carbon emission reduction per year of about 3%. It's probably a bit more that we need. And the sooner we start, the lower it would be. But unfortunately, sometimes it's slower than what we think. And then we calibrate the orderly versus disorderly scenario, which are proposed by the NGFS, for instance. So this is in the end, this model is versatile, but there is some smart ways when you understand exactly how the economy works to calibrate it, and that's what I wanted to relate here. So if we move to the next slide now, and I know I'm on time. Just want to give you, if you give me one more minute, Sander. Just want to show also what other things we're working on in Green RWA. This is, for example, the greenium. The greenium is essentially the difference of price between a vanilla bond and a green bond. Of course, we think it's positive, but we're working on specific ways to model that on the relevant factors, based on bond data from the capital market. And this is where we work also on the capital market book of banks. And then there are many usages of this greenium. If it's properly identified, that could be very helpful to make the transition happen. And the very last thing I want to say, if I want to make a call of action, Sander, if you show the last slide, is that our network is growing fast, but it's also a non-profit, and we're really willing to onboard new members. And so whether you're a consultancy, a banker, or financial specialist, and you come with knowledge, or just want to support us financially, of course, feel free to reach out to us, contact us at greenrw.org. The email is there. And most importantly, as a financial institution, we're on discussion with different banks to start testing the model on sample loan books. And we'd be very, very happy to engage with any of you on that path and that discussion. Thank you. I hope just on time.
Nearly. Thank you very much, Olivier. Thank you. Meanwhile, Jitske, what happened in the chat box?
Yeah, so some questions for you came in, Olivier. The first one is, what are the issues you are facing in your logical approach in building models? Developing a model based on RWA, then test it, back testing it, then put it on production. How long does it take? And thus, if there are several months, how relevant still is this process?
Yes, indeed, there is a challenge to implement models like that. I would say there is two different challenges. So it depends whether you want to just use the model at a single point, or you want to implement the model in a production mode. So at this point, we're focusing on the first one, of course, is to calibrate the model on sample loans. And if you take a dummy loan book, it's quite easy to calculate at one instance and on one point the unexpected loss derived from a loan book based on the climate financial risk. So we think this is pretty fast to do, and in the different proposal that we've made to banks to effectively implement it or test it on a sample loan book, we think it depending on the effort the banks can put on it, it comes from a few weeks to a few months to test it. Then, of course, there are some complexities when you want to put it on a production mode on your own loan book, because you need the data from to be able to properly evaluate the correlation between the borrower's strategy and the different factors of the model. So it's a challenge. But this is down the road. So for us, the first focus is really to show the ability of the model on test loan books to represent the climate risk.
Okay, thank you. So there's one more question. Hi, Olivier. Great calibration tool for climate risk. Very exciting to see this coming to the market. One question. How can green RWA's model be integrated in other existing methodologies like PCAF or current models within the banking sector?
Yes, so it's interesting because when I was looking at the presentation of Gilles, in fact, I was wondering, exactly I was wondering exactly the same question, or posing the same question to me, and how are we going to leverage that data? In fact, if you look at PCAF, it's for example, it's a carbon accounting methodology basically. So the carbon accounting is going to give you the transition risk of your company, and if you can say, the scope 1, scope 2, scope 3 are this high today, and they're going to decrease in time thanks to the strategy of the corporate to invest on either new business or new technology to reduce its carbon footprint. That's the famous example of the taxonomy, with the cement company. Then it's a way to calibrate the model. So it gives you more insight on the correlation of the borrower with the different factors of our model. And that's one example, for example, PCAF. And it's the same with the taxonomy. We are trying to use the taxonomy and the green asset ratio as a proxy to calibrate the model, so facilitate the work of the bank, not to have to collect the data multiple times.
Thank you. So those were the questions that came in via the chat.
Thank you, Jitske. Thank you very much. Thank you, Olivier, as well. Thank you, the audience, for bringing in those questions and bringing them up. I think, given the time, and it's nearly 1 o'clock, let's wrap up. We have discussed climate risks, especially in relation to risk management and also the challenges that it brings. We have seen a couple of solutions coming up as well, and we have seen how you can use these solutions in risk management. Given all the questions in the chat, I think the discussion is far from over. So let's continue the discussion, I would say. Thank you, Tjeerd Krumpelman and Olivier Vinciguerra for your presentations. And let's see what's next. What's next is that after this webinar, we would like to have contact with all of you, if possible, if you are looking for additional advice, for example, if you are looking for information sessions, trainings, workshops, if you still want to discuss your open questions, please contact us. We can also organize one-on-one climate risk sessions, and let's see what is possible there. For now, I would like to thank you all for joining us today, and thank you for your active participation. We hope that you also found this an interesting hour. Have a very nice day. Stay healthy, and let's hope that we can speak each other soon, and preferably that is in person again. Thank you very much.
Thank you. Bye-bye.